Okay, we're going to look at the last part of our investments unit, which is all about retirement investments. So this actually broken down into 2 days. This first part is going to be more just about the different types, and then the second day will be more math. But once again, we're looking at retirement investments. Before you even start thinking about retirement, they say, hey, when you're planning for it, conduct a financial analysis. So kind of look at what you have and where you're planning on going. So they say your net worth, or how much money you're worth, is your assets. So anything that you own that's of value, so maybe like if you own your car or if you have money in the bank account, that would be an asset. But then you got to subtract your liabilities. So things that you still owe money on. So maybe like you haven't paid off your house, and that would be considered a liability. The reason they're telling you to do that is because you want to be aware of how much money you have to spend. We've got a funny kind of joke over here that says, I'm going to retire and live off my savings. What I'll do the second week, I have no idea. You want to have enough money such that you can provide for the certain lifestyle that you're used to or that you plan to live. So if you want to take lots of vacations, you're going to need a little bit more money than if you're someone who's going to just kind of stay at home and your house is all paid off. The next thing they say to kind of be aware of as well is, how does inflation impact retirement? So remember, inflation is that idea that prices will kind of rise over time, that your money is not going to be worth as much. So you want to make sure that your investment rates beat inflation. So that your money does not lose value. Okay, so now let's take a look at the different types of retirement plans or retirement options you can have. So this first one, they say, is Social Security. And we've actually talked about this in our taxes unit. Remember, that's the money that you pay out of your paycheck on a regular basis and provides for kind of retirement. It provides benefits to retirees, survivors, or disabled persons, right? To qualify for retirement benefits, you must earn a certain number of credits. These credits are based on the length of time you work and pay Social Security tax or contributions on your earnings. So be aware that money doesn't just magically appear, like you have been contributing to that fund throughout your employment. Okay, next they say, okay, public pension plans. So I'll be honest, few workers still have the option of public pensions. Most of these are common for workers of like the federal government. Or it could be like the state and local government as well. It could be for people like railroad employees, or even like some veterans, administration, etc. But we're talking about people who work for the public. Okay. The next option, this one probably is quite common. You probably have heard this before. It's called a 401k. And it's a salary reduction plan, aka they're taking money out of your paycheck on a regular basis. So the cool thing about this one is many employers will actually match their employees' 401k contributions up to a specific amount, dollar amount, or percentage of the salary. So your annual salary, let's say it's $35,000. And your employer will match up to 3% of the $35,000. That means if you contribute 3%, so 3%, which is, as you move the decimal twice to the left, 0.03 times 35,000 is $1,050. That's how much you put into your retirement each year. But if your employer matches that, they're also going to put in that same exact amount, $1,050. So therefore, in the end of the year, if you take what you put in and you add what your employer puts in, we would have a total of $2,100 that was contributed for the year. So you're almost just doubling your money simply by putting it in there. Okay, so let's look at an example. Let's try to do this. So last year you contributed 4% of your annual salary of $40,000 to a 401k. If your employer matches the contribution, what is the total amount contributed to your 401k last year? So let's think about what you put in, what you contribute. Well, that's just basically saying what's 4% of 40,000. So we're going to do 0.04 times 40,000, and we get $1,600. But if that's how much you put in, remember it says your employer matches. So therefore, they're also going to put in that same amount, $1,600. So the total will be the sum of both what you contribute and your employer contributes. So you would have a total of $3,200 that you put into your account last year. Okay, there's a few other ones. So a 403B plan, I think this is our fourth one, is if you're already employed by a tax-exempt institution. So these are things such as like a hospital or a nonprofit organization. That salary reduction plan is called a 403B. Basically, this is the same as like the 401k, just a slightly different name for depending on the company you work for. The funds in this plan are also tax deferred. So that means you don't pay taxes right now, but you pay taxes when you withdraw the money. And that's similar in your 401k usually. Okay, the last ones is IRAs. And these are individual retirement accounts. There's two different types, so I'm going to start with the traditional. A traditional IRA is an individual retirement account that allows individuals to direct pre-tax income up to a specific annual limits toward investments that can grow tax deferred. So that means, hey, you pay before you put money in before you get taxes, and then when you withdraw the money, you'll pay some taxes. This allows you to make contributions until you're 70 and a half, so 70.5. And as of 2015, if you're under 50, so this would be you can contribute up to $5,500 a year, and a person over 50 can contribute $6,000 per year. Okay, a Roth IRA is really similar. The difference is, rather than similar to your regular traditional IRA, but the annual contributions of a Roth IRA are taxed. So you pay taxes before you put the money in, but then any interest you earn on it is tax-free. So like let's say you put in $5,000 and then by the time you retire it's $20,000, you only pay taxes on the first $5,000 you put in, whereas the traditional ones you pay it on the entire $20,000, so including what you made. You can contribute this the same amounts as for a regular IRA, and you can continue to make contributions even after you're 70 and a half. You can also withdraw the money from the account without paying taxes or penalties after 5 years if you're at least 59 and a half, or if you're using the money to help pay for your first home. There's also other reasons too, like for education, etc., which also hold true for your traditional IRAs, your 401ks. Be aware, and this is what we're going to talk about next time more, but you do pay a 10% penalty if you withdraw funds from your traditional IRA or 401k before you're 59 and a half. You're required to begin, so that means, okay, if you withdraw early and you need the money before you retire, then you will end up paying kind of a penalty. You are, though, required to begin withdrawing from a traditional IRA or 401k at the age of 70 and a half. So once you get to a certain retirement age, they make you withdraw because the government wants to collect taxes for you. So if you don't, you'll pay a penalty equal to 50% of the money that 50% of the amount you should have withdrawn. These funds are called your required minimum distribution. The amount you must begin withdrawing is based on your life expectancy. So how long they expect you to live. And the fair market value of your IRA, so how much money's in there. Your expectancy, your life expectancy, is considered the distribution period of your IRA. So, is that all the retirement options? No, of course not. But it gives you an idea of some of the things that you'll likely run into and some options you'll be given